Well, thank you guys for joining again, and apologies for the technology issues. Um, for those that try to join via live stream, I hope you guys can hear me okay, and let me know if we have any audio issues. I'm getting a new setup today, the camera and the mic and all that. So I've tested it before, so hopefully it works. So I see a few of the familiar faces here today. So love to just catch up afterwards as well if we don't get a chance to talk in details today. So anyways, let me get started with a screen share. So today I wanted to just talk through this topic, vetting real estate syndication investments as a passive investor. Most of you guys already know me here, but before we get started, disclaimer that following information is only for information, general is of general nature. So please consult with your tax, CPA, investment advisor before making any investment decisions. And this is not a solicitation for investment. Today, what we'll cover is an introduction of me, the company, and absolute basics of syndication to catch up some of the people who may be new to this topic, and also what to watch out for, and a brief case study, just going over it together, and Q&A. So if you're not speaking, please mute yourself. Thank you. Okay, great. So for those that don't know about me, I'm the managing partner at Life Mission Capital. I invested in 158 units in multifamily across both passive and active investments. And my goal right now is really to help people achieve financial freedom through real estate syndications, even though real estate syndications are one piece of many pieces of puzzle that we can do to achieve financial freedom. Initially from China, I came to the US in 2009, and over the years, I've gained a diverse set of experience across data analytics, buying, sales, and IT. And I started a real estate investment club in Walmart. We have over 400 members today. I've been featured on a few podcasts and as well. My company is really about enabling investors to reach their financial freedom goals so they can focus on what matters. From me, I have a data background. So for our investments and the company's investments and how we help past investors is really make sure we use a data-driven approach on our underwriting and our vetting process as well, which is some of the things I'll go over today. And we have a network of experienced and reliable sponsors. And at the end of the day, we're really here to build meaningful relationships with investors and the partners. So apart from me, there are a few people that I partner with, and I like to highlight my mentor and also advisor, David Monroe, CCIM. He's very strong in underwriting and market analysis. He holds the CCIM title. He also teaches CCIM, which is the Certified Commercial Investment Member in the real estate space. And he has been investing for the past decade, and along with Jim Biggs as well, has more than 2 decades of experience in the space. And Charles Simon is someone who I always consult with from a underwriting standpoint as well. He hosts a underwriting workshop on Saturdays. I don't want to go too much into details of this, but we work with full cycle experience sponsors, mostly in Sunbelt regions, and oops. Okay, here we go, keyboard working. And we focus on B and C class, looking at high teens returns, and also we really want to make sure we're investing conservatively with our investors' funds and also our own funds as well. So some absolute syndication basics. Syndication is really just pooling investors' funds and also resources and expertise. And resources and expertise typically come from the active investors. That could be me and my partners. And then funds, it could be me and my partners, well, from passive investors. We form an LLC, and the LLC essentially owns the property. And that's essentially a security governed by the Securities and Exchange Commission. In fact, in 2020, over 120,000 investors participated in syndication with an average size of offering of $3 million. There's 506B, 506C. I don't want to go too much into details, but those are two different types of offerings, and feel free to ask me later. So those are some of the top reasons to invest in real estate syndications. I'm just going to type them all out. They're very recession resistant, and for passive investing, we don't have to worry about tenants' toilets, huge tax savings, and there's a lot of access to large investment opportunities versus single family home. In fact, I was having a headache today dealing with my single family home, which I'm really trying to get rid of a little bit with black mold and different issues. And so it can be a headache. It's also a good place, without exposing a lot of personal liabilities and credit risk while still getting great returns. Quick run through some of the terminologies before we get into some of the vetting part, so it makes sense to some of you. So net operating income is when we look at the investment, we have operating income after we take out expenses, and before we look at the debt services, that's what we consider net operating income. And why is that important? Because in commercial real estate, it helps determine the purchase price, or it could also be the sell price when you exit the property. Net operating income divided by purchase price is essentially the cap rate. And when we compare investment across different areas, we may be looking at a few different measures. One of them is a cash on cash return. So how much return are you getting on an annual basis as a percentage of the cash you invested? And the equity multiplier, typically you'll hear people say that equity multiplier of 2. For example, if you invest 100,000, you get 200,000 in return, including the principal you put in. And IRR, internal rate of return, is a way of calculating investment's return considering the time value of money. So $1 today is worth more than $1 tomorrow. So how do we really evaluate the investment opportunity that gives the same 100,000 back, but at different times of the year or through the whole period? So now let's look at a investment example quickly together. Actually, I have it on the next slide here as well. This is just an example. It is not a offering. So typically when you see an example, an investment, this is a one-pager. I tried to make it brief here. Typically you'll see things like where this property is at, what kind of, how many units, what's the opportunity here. Typically a lot of times you'll see your value add to increase the rent, and how's the cash flow in terms of some of the metrics we mentioned, and how much you purchased it at, and what's the plan, right? Typically there's a business plan to improve interior exteriors and reposition it, and what are the fees the managers are charging, and what's their exit strategy, and what would it look like if you invest $100,000 here. So while it looks good, this is potentially a good investment. Can we really trust to invest just with information like this? And that's where we'll get into kind of the meat of the presentation today. So how do we vet real estate syndication investments as a passive investor? Taking the experiences from some of my partners, those are some of the areas that I have seen are most important. We need to vet the sponsor and their team, the market, the submarket, the property, and the underwriting. And I highlighted the sponsors and their team because that is one of the most important pieces. Even if you may not have the perfect property, but if the sponsor and their team, they're really capable and know what they're doing, they could make a not so good investment perform really well. And I do want to kind of put a word of caution about information I'll be sharing with you a little bit later in terms of the details, because I'm going to look in a lot more depth in the later slides. And I want to tell you that you can spend endless amount of time vetting if you want, or you can leave it to the experts or people who do this day in and day out, companies like mine or my partners, because there's a lot more details you can go into where you can stay at a high level and with some level of trust as well. So vetting the sponsor and their team, and I didn't cover this earlier. We have questions and answer at the end. So if you have questions, feel free to tap in the chat. We'll just wait until later. So vetting the sponsor of the team. So number one thing you've heard before probably is what's the sponsor's track record? I just typed out some of the columns that track on my little Excel file that I have. I ask the sponsor on what's the property they owned when they owned it, and kind of what's the return on that as well, the purchase date and sell date. And I look for also who are the references I can talk to, or ask around in my network as well who may know those people. So that's number one. And also how their fee structure aligns with their investors, which we'll talk a little bit more in the later slides as well. That also speaks for, are they really here just to make an acquisition fee and then refinance fee and all these fees, versus really trying to align their returns along with the investors' returns as well. And also, when you're doing references, some of the questions you can ask is, are they doing on-time communications? How are their distributions? Are they coming on time? If not, what are the reasons? And also background checks. You'll be surprised. You don't have to ask people for their social security number. You can just ask people for some of the general information. You can conduct background checks on them as well. Of course, some of this information, some of the companies like Verivest, they do that for some of the sponsors. But I found, not everyone's on those platforms. And even being on those platforms, not everyone's vetted 100% at all times. So it's always good to have some of your own references and background checks, and just understand, especially if you're working with someone for the first time in that area. And another thing I think it's important to ask is understand how they deal with the challenges in their business, particularly recessions or time of stress. As we know that we just recently, experienced a pandemic. We're not quite over it yet, but at the beginning of the pandemic, there were certain hotels and also apartments that really struggled, and they freaked out and they sold the property without really getting the returns that they promised their investors. So what they do the same, right? So if they haven't really gone through the 2008-9 recession, ask them if, what did they do during the pandemic? How did they deal with it? Did they lose investors' money? How did they deal with it? With some of the sponsors, if they have done this plenty of times, there's going to be a time that they may lose investors' money, or they may not make the returns that that's promised, we're just playing with probability here. But what's also important is how they deal with it, what they learn from it as well. Who are the team that they're working with? Like how I introduced about my team, and who are the property management team that they typically work with in the market they work with, and understand the reviews on those property management team as well. And one of the things to be aware is also teams that's really vertically integrated, understand how their bidding process works. For example, if a team has a construction company, how are they, getting their bids out to potentially make sure that they're actually one of the most competitive bidders on a renovation and things like that, versus it's just moving, money from left pocket to the right pocket, saying we save investors money. On the other side, just money went into maybe their construction company or something. So what kind of process do they have in there to make sure of that that's good for investors, since we're not auditing them on a day in day out basis? So what do they have in process to make sure of that? And what lenders and lawyers do they work with? Anyone purchased a home, sometimes they run into lenders, they change things, what can't close the day before, and then you have to delay closing. Same thing can happen in this space as well. Are they familiar with their lenders? Have they worked with their lenders before? Especially if it's a larger deal that they haven't taken on before. And who are the syndication lawyers do they work with? How long have they been working with those people, and what their experiences are? And any other key partners on their team, who's doing what for how long, right? Instead of just everyone on the team, but what do they do exactly? And the other piece is the market. We all know real estate follows people. So we have the consensus data that we can usually review, but that's usually 1 year or two behind, depending on when you look at it. And also another good data set that's good to look at, just U-Haul moving data to see where people are moving. And you want to make sure the area you're investing, at least in my perspective, for my investment thesis, I want to make sure it's an area that's continuing to grow. And also the income in the area meets the type of class you're investing as well. And basic jobs, this is important. It's basically a concept of, you can have 10,000 jobs in the town, but are those 10,000 jobs are like all bakeries and restaurants and grocery stores, or are those 10,000 factory jobs? Obviously, those are different. Typically, almost factory jobs, the money is coming from outside the city and to the city, versus like restaurants, dining, they're just money circulating within the city essentially. So how can we continue to grow the economy by having maybe factory jobs, or Walmart headquarters, like for example where I live, where we're bringing money from the outside to be spending inside, and that's really what's stimulating the economy inside. And are people renting a lot compared to owning, if you're looking at multifamily? And how friendly is their landlord policy, right? People are moving out of New York and California for their investments for reasons like this, right? They're not very landlord friendly. And what about natural disasters? Are you okay with those type of natural disasters, even though there's insurance in place? And learn from the Chamber of Commerce about that area. I know it sounds like a long list of things, but if it's a few markets you're familiar with, a lot of the stuff already. If it's not a market you're familiar with, it just depends on how much risk you're wanting to take with your investment. If you want to feel more comfortable, you can do a lot more research. That's why I say it can be an endless list of things, but those are some of the major things you can check to make sure you feel more comfortable. I know not everyone has access to CoStar data, but some of the websites like city-data.com has a lot of the information as well. It may not be the most updated, but it's good enough for some preliminary researches if you're looking for this type of information. And it also has like by zip code, income and crime rates and different things. So when we move into the specific stock market, maybe like a zip code or a city within the metropolitan area, when we look at a specific property, we want to also look at a 1 mile, 3 mile, 5 mile radius, make sure the median household income meets the rent we're trying to charge, typically 3 times rent to income, income to rent. And do they have access to jobs within 20 to 30-minute commute? It depends on the type of asset class you're investing, right? For multifamily, typically that's probably what you want to look at. And but maybe for factory jobs, it could be a little bit further out, depending on the area. And access to services, food, restaurants, and schools, depending on what type of resident you're targeting. If it's all 1 bedroom, maybe school isn't so important. If it's more of a transient workforce, but otherwise you may want to look at the school as well. In terms of crime rate, I typically like to invest below 400 in crime index. And also competition, who's coming onto the market, what rent are they charging? How is that going to affect the vacancies that this investment opportunity is projecting? And the competitors, and what's their occupancy right now? What rent they're charging? Understand those as well. That's where you're vetting the submarket. Understand that a lot of times the sponsors will have some of the information on there. But if it's your first time working with them, it doesn't hurt to double check on a few things, and ask questions. Even if it's your third, fourth time, just depends on your comfort level. And what's the future growth in the area? You can definitely ask the Chamber of Commerce, people who are local, read news. Another little test I like to do is see if there are signs of gentrifications, especially when we're trying to work with some of the C-class areas. how far away is a Starbucks? If it's within a mile or two, but the area is still a C class area, so maybe this area is upcoming because Starbucks says so. No, it's not the most scientific just from looking at it, but I think Starbucks does a great job picking their locations. So, and from a property standpoint, what is the age of the property? What building materials do they have? What was some of the recent renovations done? What's the plumbing and electrical types? Is it really old galvanized plumbing that could be having a lot more plumbing issues? So is it aluminum wires that could be easily causing fires? And just knowing some of the risks and ask those questions and see how the sponsors intend to deal with them. Have they done the due diligence on it? How old is the roof? And who's renting right now? Like what kind of tenants? Is it students? Is it older clientele? Or is it families? And what type of delinquencies? Those all can give you an idea of kind of some of the risks involved within the properties as well. And the next piece is about the underwriting piece. And I know this may be a little bit more in detail, but you should understand that most of the sponsors will not share underwriting details with the passive investors because maybe they have their proprietary underwriting software, or they're not willing to share every little assumptions, but they're okay with telling you about it if you ask about it, or maybe they'll get on the call with you and just walk you through some of their assumptions as well. Underwriting is really, right, kind of adding up numbers. So we all know 1 + 1 = 2, but so where did that number come from? What derives the number? So it's really about where is that one coming from and where is that other one coming from, and where do you arrive at those assumptions? So I think there's about 10 areas I've seen that's fairly overlooked in underwriting. One is reduced or same taxes and insurance during business plan. I like it when the sponsors actually write out kind of their expenses by category and show the passive investors in the webinar, but sometimes people don't do that. They just kind of clump it all together. And I want to see, are they really increasing their taxes and they're increasing their insurance? Because generally speaking, those things are not going down. And what's the asking rent versus the actual rent? Are they actually using asking rent as the rent now, or are they using actual rent in their underwriting? You'll be surprised. Some people make that mistake, and then they take from asking rent to pro forma versus what's actually correct into pro forma. Also, refinance and exit cap rate. You probably heard this, that we want to increase at least 10 basis points per year during the hold. And I really capitalized 10 basis points. And the reason is that, when the market does go down, it doesn't go down that slowly. It drops really fast. So at least is very important to be at least 10 basis points. As I mentioned earlier, cap rate affects the sale price. And typically on the investments, you will have returns from both the cash flow and also the sale. So if you're not able to sell more because you didn't assume that the cap rate is going to be as high, then you may not be able to get the returns you projected. Also, the thing I mentioned earlier about 1 to 3 mile radius, able to 3 times rent to income to rent. I always flip that. And then payroll reductions. People don't typically like to work for less if you're in the same company. One thing is if you're in a new company in the property management area, maybe they're okay with a little less payroll, but typically people don't want to reduce their payrolls. And also you're likely to lose property managers who don't want to take a payroll reduction. Therefore, you're losing a lot of knowledge that you could have had within the property. Also, as you know, that we're seeing a lot of bridge debt being taken in the probably past year or two, a lot of the deals is bridge debt, refinance, and get into another loan for a few years. So with the bridge debt, it's floating rate. So what's their max rate that they're capped at? And when you run a stress test, are they able to cover their bills if the rate goes up to the maximum by a certain year, for example? So understand how that impacts cash flows, because the last thing you want is a capital call telling investors, oh, we can't meet our, especially while you're stabilizing the property, we can't meet our investors return. We don't have cash flow because the rates just went up. Our loan terms are way higher than we expected. And also flexible exit. What are the assumable, is it assumable loan that the next buyer can assume if you exit? Is there a prepayment penalty? And can they get a 10-year debt? So since the market is so hot, everyone in my neighborhood, I feel like, is talking about market's going to go down at some point very soon. And will they be forced to sell because they only have like 5-year or 3-year loan? Or can they have a longer term loan versus just a very short loan? And also, what's their insurance coverage? Yes, maybe they'll find ways to get cheaper insurance, but what's the coverage? Is it 80% covered, 90% covered? Do they have umbrella insurance? Does it cover rent loss, especially when it comes to natural disasters and things like that? That's really out of our control. And understand what's the return of capital versus return on capital. You're getting the $100,000 you invested back, that's return of capital, but you're getting 10% return on that 100,000, that's return on capital. Understand that the differentiation on that. And lastly, what's the break-even occupancy after stabilization? Assuming that their pro forma rent is reasonable after the stabilize, let's not talk about the work and risks involved while they're stabilizing the property, but let's say after they stabilize, what's their break-even occupancy? Typically below 75% is good, and I've seen some with 65%. That's like, I don't think I can lose my money there. So but those are hard to find, right? Like we're seeing more and more that's like around 80, 85, and that's just more risks as well. So I know I went through things really fast, and I'm happy to answer any questions. And one of the reasons I did is because I was thinking we can look at the offer memorandum together. This is an example as well on the earlier one that I shared with you guys. And, we can just walk through it together, pretending it's not my company name that's on there. And just what are the questions that Micy want to ask when I look at this investment? And when I look through the slides, what are some of the questions you can ask? So like I said, this is an example, so ignore who's on there. But if this is me looking at another company, I'll be asking, so this is the sponsor team, like who's doing what on this specific property, and what are the experiences? Do they have experiences on this market, etc., which wasn't covered on the slides. And okay, I'm getting some really great stats on what Tulsa is about. This property is in Tulsa, and it looks great, and a lot of employees, and great place to live. And we're seeing a lot of job diversification, so that's always good from a market standpoint. That's one of the things about economy diversification. And this is a sub-market in Tulsa, and what they liked about it and some of the great things that's happening. That's great. I think on the earlier slide, they mentioned how many jobs are there. Yeah, some of the jobs, some of the top public schools. And if we look at 1 mile, 3 mile, 5 mile radius, the density isn't as high as I would like. It's only 13,000 people in 5 mile, but knowing that it's right outside Tulsa, that changes the picture because people may commute and go to a lot more places. So those are the return metrics they have. So let's see, based on some of the areas we covered, or how likely are they to meet those returns, right? So this is the property address. Again, this is a sample investment. It was recently updated, and those are the building types: playground and 100 units. The property looks nice. Looks like they have a lot of good amenities and fairly clean and organized, especially with their model units. So basically they're saying this is our plan to do renovations in each unit for 1 bedroom and 2 bedroom, and they have different types of buildings. One is apartment style, the other one's a plex style. And those are some of the exterior improvements they'll do, privacy fence and gutters, dog park, and any additional ways to improve income and reducing expenses. Okay, and exit in 5 years. So this is a list of their CapEx budget, and it's good that they divide it by different types of unit that may require different types of amount in terms of renovations because of what they have in place today. So very detailed. I like that. And now we look at comps. So we talked about competitors in the submarket. So the subject is here, and the comps they have given it's just right outside it. It didn't seem to be very far, maybe within a mile or so. And it seems to be in the same neighborhood. So that's good. And you don't have to do this, but I actually call up those places and I check their rent. And I go online as well just to double check. And you can see what's their pro forma versus current. The gap isn't that big in terms of what they're raising. Obviously, there's no way you can check those are actual rent they're collecting instead of asking rent. But assuming that is, and they wrote their information correctly, you're saying, the increase seems to be not that large, relatively speaking, except for the two bedrooms, but it's still comparable to what we're seeing compared to our comps that we're seeing. About $1.16, and pro forma is going to be $1.10. So this is, I'm looking at their pro forma. This is where we can look at some of the things I mentioned in, like, okay, are their insurances increasing? And the good thing is it is year one. They're increasing a little bit each year. And also looking at their taxes, the taxes are increasing as well. That's good. And also, depending on the area, they get reappraised every few years. So that's going to increase as well. But it's always generally good to have some type of increases in there as a buffer. And then we see that the payroll, I don't know if they're keeping the same company, but it's overall increasing as well. So those are our good things that's checking out on here. So we're continuing to vet. And stabilized comps, what's the cap rate right now? 6.15, and compared to the other ones. So it seems to be competitive from a purchase price standpoint. And this is the returns that they're projecting, and how the it's a 5-year hold. Cap rate that purchased 6.2, and in 5 years they're doing more than 10 basis point increase. So that's good. And then the debt summary, and they have 4-point interest, and it's this one's a bank loan, and it's fixed, so it's not floating. So that's good to know that. And there's it fixes every 5 years, and it's a fairly long term. And this is kind of the investments returns. So this is return of capital versus return on capital. So you're returning, let's take the 100 $100,000 investment as an example, it's returning total returns 800,000 on year one. That's from cash flow. Year two, 800 roughly 900. I'm sorry, 8,000, 9,000, 9,000, and then there's 164. This is still return on capital, and then this is return of capital. You see, it sounds very similar, but it's different. So the returns you're getting back is what 64,000 on this one out of $100,000 investment. And this is a property management team, and seems like they have a lot of experience, so that's good. I may look up online on how they're doing exactly in some of the property they manage if I want to do that deep of a level in terms of the due diligence. And those are some of the comps, and those are the next steps to subscribe and invest. But from looking at this one, and it seems like a good investment opportunity. Maybe some of the things I would ask you, if we go back to what we talked about before, some of the things I may ask is what's the break-even occupancy? And that can help you understand after stabilization, how likely if a recession hit and things like that, how likely they will be able to continue to pay their bills if people can't pay their rent, et cetera, et cetera. So those are some of the things I prepared, and just wanted to open up for questions, thoughts on what I presented. If you're, I have an ebook that actually covers this. I have 110 questions listed in there that you can ask the sponsors, and maybe not actually asking them the 110, but kind of looking through it, compare with information you have, and see what questions you may still have. You're always welcome to book another meeting with me if you have any additional questions. But those are some of the things it would be good for you to vet and do a due diligence on, whether it's at sponsor level and the market level before investment opportunity is available, or even now. Okay. Yes. George Ekins is asking who's the sponsor for this project. So that's actually a project from the Adventurous REI. And it's Susie and Michael, and they were working with some experienced operators on that particular deal. I don't remember their names, but it was, when they did this deal, it was their second or third deal, but they were working with other people who were more experienced, overseeing them in that project. I think their market right now is more focused in Oklahoma area.
Hey, Micy, I have a question about renovations. What is your strategy there? Do you plan to renovate all the units in a complex, or do you think it's wise to leave maybe 25% or 50% of them unrenovated so that the next investor has something to add value to the property when they acquired it from you?
Yeah, I think ideally you want to leave some just for that. And it also depends on what kind of market. So ideally, right, you like to leave, it would be good to leave some, that way, like you said, meat on the bone. And even if the market isn't that strong, the fact that they're able to do value add, they're able to make the deal look better. But if you don't have anything left for them, they just have to rely 100% on cash flow, which may not make the returns they wanted. And now another approach I've seen people do, it's a little bit more aggressive, is kind of seeing how the area is going to be like. If they feel like the area is going really strong, they may continue to take it to the level they can, and then they think it's a B now. When the area becomes they think it's a C, they're going to take it to like a nice C. But when the area becomes a B, there's meat on the bone for the investors again. But that's depending on how their knowledge of the market is, how
how they feel about the market and how you feel their knowledge is in the market. To be conservative, it's always good to leave a little bit meat on the bone. So that would be my take on it.
Right. Is there like a rule of thumb that you use to figure out what percentage of units to leave unmodified?
I don't know if there is a rule of thumb. I think 25, 30, 40% is pretty good from what I've seen, what people have done. I think what I've seen the challenge, because I look at a lot of the deals that the sponsor pass on to me before they even have an offering available, is a lot of times they can afford not to renovate as many as they can. Like they have to renovate like 70, 80 or even higher units to make the numbers work from a cash flow standpoint. And that's the struggle. So how to find those opportunities that can leave some meat on the bone, still feel conservative. Would unless the sponsor know the market really well, that they can maybe reposition it, leave meat on the bone, but more for another asset play. So that's what I've seen. Yeah.
Okay, thank you.
Yeah, sure. I think we see some other questions. Break-even occupancy. So when it's apartment, right, we have the income that comes in, and then you have to pay expenses like payroll or maintenance and things like that. So let's say you have $100,000 in income and you take typical expenses, there's around 50%. Let's just for the example, let's say 55%. You have $55,000 in expenses, so you have $45,000 left. And if your mortgage payment is $35,000, then you get $10,000. That's your cash flow, and that's good. But what if your occupancy dropped to a certain point that you can't afford those $10,000 anymore, and that's not good. So what's that break even where the lowest occupancy you can get that you can still make your payments, so that you can still keep the operations going? So think about the pandemic when pandemic really kicked off in March and March 2020. Some of the people, they couldn't collect money and the government funding hasn't kicked in yet. And they're struggling because their vacancy dropped a lot and they just didn't have enough to cover. So they're forced to sell or forced to foreclose, or they're forced to get capital from the investors. So hopefully that clarifies, Rama. I'm trying to find okay, great. I'm trying to find the link for you on the ebook. 1 second. So go to lifemissioncapital.com. And I hope the link is working on for download, because it wasn't, and I had my developer fixing it, but I don't know. Seems like it wasn't working again. But if it's not, just let me know. And I think there was another question here. Oh, can I see the ebook? Oh, what's the CapEx? It's capital expenditure budget. So basically, if you need to replace roof, replace water heater, things like that, you don't really put that as a maintenance expense. You would typically put it as a capital expenditure budget. And you typically see people have more CapEx rather than expenses when they're getting closer to sale, because they want to reduce their expenses. Therefore, makes their income look higher. Therefore, hopefully they'll sell at a higher price. But in short, CapEx is capital expenditure.
Hey, Micy, I'll ask another one. What are your thoughts on build to rent investments and properties?
Yeah, I think it's actually very good in some of those areas. I saw some of the opportunities that I think the key thing is to locking contracts and stuff ahead of time. First of all, my knowledge in that space is limited, but from what I've seen, it's growing really well. From some of the offer memorandum I've seen, and the fact that they're able to lock in all of their contractors into a fixed rate, or close to fixed rate in their building materials and timelines. And the market just continue to appreciate before they even build it.
Right.
And then the rent keeps going up before they even build it. So I mean, obviously it depends on the area, but in general, I feel like It's a good market, and I've seen some great returns on that. Yeah. And Matthew asked, what's the passive investor requirement? So if I haven't talked to you, and so there's two types of investment. We talk about 506B and 506C. 506B is for people that me or the sponsor needs to have a pre-existing relationship with. And that means we need to have some type of calls before opportunity is available, that so that I understand, your situation, your financial situation, your investment criteria, whether you're a credit investor or not, that's doesn't matter. You can invest in 506B as long as I know you, basically. But if you're a 506, want to invest in 506C, you have to be a credit investor. So that means typically means you have to have $1 million in net worth or more, or $200,000 in single filing, or $300,000 in joint filing. And there's also some security license you can have as a credit investors as well. But most of the times it's those two criterias to be accredited. So if Matthew, if you want to invest and if you want to check out some of the opportunities in the future that I have, let's talk.
Hey, Micy, thank you. I have a question. As far as like the financial information that the sponsor would share, I know that you mentioned they don't share all the assumptions and some of the underlying data or underwriting information. Are there any reportings or any kind of audits where the information that you're getting can be, verified, or you can trust it, not somebody just kind of putting up some numbers and making them look good? Like how is that? How often that happens compared to doing more due diligence, making sure that the information is accurate?
Yeah, I think you start with a higher level. Although I list a lot of things, if you think about it, what makes the investment good is the cash flow and the sale, right? So for cash flow, you have income, you have expenses, you have debt services. So how do you verify income, the current income? If you really want to just go to apartments.com and look at it, but that's asking rent, right? So you have, but it gives you an idea. And in terms of expenses, a lot of times it's around 50%. So it gives you a ballpark on where that investment is. But to get to the details, if you really have the desire to get to those details, you can talk to the sponsor or the general partner that you're talking to get to those level of details. And then in terms of mortgage and debt, you can typically see on their slides where you can calculate based on, what rates they have and things like that. It's a level of balance to get into so many details that you felt like you can't make a decision versus, enough that you feel like you're comfortable with the decision. And
yeah. Thank you.
Sure. Thank you, Hussein. Cool. And I'll just have a couple more minutes. Any other thoughts from anyone?
So, Micy, what is I know that you've been working very hard on your company. What will be, how many deals that you've had so far, or what will be the next deal you're looking at? Are you right now any deal that you have right now, on your radar?
Yes. So what was the two questions again? I think
I would just question, like, how many deals have you closed so far, and if there's any one on the radar that you're currently looking at? Or...
Yeah. So in terms of syndication, I finished one, but what I'm doing right now is looking at a lot of other opportunities, and I'm leveraging the experiences of my partners who has done decades of experiences in 10, 20 deals in those spaces. And I'm not just looking at multifamily, and the position I'm in is more of a fund manager rather than actually people who's doing things on the ground. The reason is I don't want to just look at multifamily. There are other asset class I'm very interested in and I'm learning about. And like, for example, in the past 2 months, I spent about 12 days with the operator learning about hotel operations. So things like that. It's going to be impossible for me to have experience in every asset class, a lot of experience in every asset class I go into, But what I rely on is due diligence on those sponsors and learn on the asset class and pass that comfort level to my investors.
I see.
Mhm.
So Micy, what are the other assets you're looking at?
Yeah, hotels, specifically extended stays, and also mobile home parks and soft storage.
Okay.
Yeah, but that's a lot of things. Right now I'm looking most intensely on the hotel side until like, and I'm looking at doing some deals myself without investors' money potentially in the next couple of weeks or month, before I even involve investors' money, just because it's an area I think there's a lot of opportunities and risks at the same time, and I want to make sure I understand those before I involve investors' funds.
Cool.
Cool. Any other thoughts, anyone? Hey, Ken, long time no see. How's Chicago? Not to call you out or anything. Cool.
Chicago's great. Thank you.
Yes, awesome. Cool. Yeah. Any other thoughts, questions? We're supposed to be going live today, guys. I'm sorry it didn't work out. I left the registration information on the website. Hopefully people will join. I honestly can't figure out the restream thing very well. So
Micy, I have one last question, and it's kind of a general one, so it may be difficult to answer, but
Mhm.
what's your strategy for investing for appreciation versus cash flow?
Yeah. So for me and my investors, most of them are more on the cash flow side than the appreciation, because this is one of the struggles I have with syndication model in general. Is typically there's a 5-year hold or 6-year hold, and that's why I like the longer term hold. That way you can decide if the market is hot, you can decide when is a good time to sell. Sorry, I'm gonna mute you, Hussein.
Oh,
because there is noise coming from a place. So so what I was trying to say is so that it depends on market timing, right? Like some of the homes we're looking at, let's say, or properties we're looking at, they may be back to pre-2009 level or something like that. So we have to depend heavily on market timing. So unless the loan is really long, like 10 years or something, I would be more heavily on cash flow, just to make sure I'm recouping the money I'm putting in, returning on my capital, versus waiting, not having much cash flow and then waiting to year 3 or year 5 and then just for the sell. What if the market isn't good? So I think the flexibility of the exit is really important. Because for most of the syndications, people want to get their money back. So the hold is only for a finite period of time. It's not one of those you buy and hold forever asset. Therefore, understanding how long the term is and when you can exit will help you determine how comfortable you're with how much cash flow. At least that's one of the models I look at for my personal investments. For my investors, we always look at cash flow because a lot of people are relying on cash flows. Either now or in the next few years for their financial freedom goals.
Okay, thank you. Great.
Okay, then. Okay, then. Awesome. I think that's it for everyone. Thank you all so much for joining. George asked, what is the cash flow projections quarterly? Are you talking about on that specific deal? Okay. I don't remember exactly. I can ping you the details later if you want. It was just an example. Okay, conceptually, the target, not necessarily on a quarterly basis, it's typically on a yearly basis, and then there's quarterly distributions typically. But on a yearly basis, we're looking at between 7 to 8% cash flow. Sometimes right now I would say between 5 to 8%. It just depends on the opportunity, because it's becoming more competitive. That's from a cash flow. But if you cross cash flow plus the appreciations, we're typically looking at in the high teens, maybe 15 to 18%. It could be higher if it's a very heavy value add. So it really depends on what's your risk tolerance as well. Sometimes it could be considered a little bit more risky, but the returns could also be a little higher. Yes, fairly good cash. Not the cash flow in high teens, but the cash flow plus appreciation. I want to clarify that. Yeah, so cash flow can be anywhere between 5 to 8% depending on the area, the market, and well, it could be 10%. But typically we're targeting 7%, hopefully. Awesome. Hopefully that answers your questions, and hopefully that was helpful. I'm happy to talk more along the line. And thank you for watching, and thank you for joining. Yeah.
Thank you. Thank you, Micy.
Yeah. Thank you, Jose. Thank you, guys.
Yeah,
Bye-bye.
great job, Micy. Thank you.
Thank you, Daniel.